Welcome to the Australian Finance Podcast, a podcast for people who want to learn more about their personal finances and get the most from their money. This series is hosted by Kate Campbell from How to Money and Owen Raszkiewicz from Rask Finance.
The Australian Finance Podcast is provided for educational purposes only. The information is general in nature and does not take into account your needs, goals, or objectives. What that means is the information does not apply to you specifically. So consider getting the advice of a licensed and trusted professional before acting on the information. Kate, welcome to the Australian Finance Podcast.
It's good to be back, Owen.
Today we're going to be talking about superannuation and retirement.
Everyone's favourite topics.
Yes, it really gets the people going, this one. And you've written a little how-to money guide on super for your website, howtomoney.online. And it's 3 reasons to start thinking about super in your 20s.
Yeah.
But it doesn't have to, as we'll get to in this episode, you don't have to be 20, you don't have to be 25, you don't have to be in your teens, you can be 30, 40, 50, 60 even, and starting to think about this stuff, and it will have a positive impact on you.
Yeah, and why it's important to think about as early as possible in your life.
For sure. And we get a lot of questions on this, right?
Absolutely.
Yeah, like we get asked, we're going to hit some of these nails on the head, but get asked, inside or outside super? Should I save more money by putting more into super? Should I keep my money in like a brokerage account or invest outside so I can retire early? You know, we get all these different kinds of questions. So we're hoping to reflect back on superannuation and the episode we did earlier in the season, but also then kind of tie it in with retirement and how you can get started today. Yeah,
and it's awesome to see because I think a few years ago, no one ever talked about superannuation. I'm suddenly starting to hear in the workplace and in my friend groups and in the media, superannuation is becoming a lot more of a common topic, and people are starting to go, oh, I actually know where my super is. I've got everything in one place and I know what fees I'm paying. So even at the hairdresser the other day, the hairdresser definitely knew where her super was. So it's really interesting that it's becoming a more common topic to talk about, and I think that's fantastic.
Yeah, as you said in your write-up, it is your money, so you've got to start treating it like that. So that's just a simple, I guess, thought process. You know? Yes, you don't have it in your bank account, but it is in your account at your super fund. So
yeah, and it's generally 9.5% of your paycheck. So normally you'd care about where nearly 10% of your money is going. So even though you don't get to see this directly in money that you can access on a daily basis, you need to care about it just as much as every other dollar.
Totally. And yeah, imagine if you had, say you get $1,000 into your bank account and $100 of that is going to this place and this account that you don't really know of or you don't really understand. If you saw that money getting taken out of your bank account, you would be really making a conscious effort to go and track it down, right?
Where did that money go? What is it giving me? What am I getting from it? Like, what are they doing with it? So I think we just forget about it because the employer just deals with it and sends the money away, so we never actually see it. And so in our mind, it's a much lower priority, and maybe we only think about it when we get our PAYG statement at the end of the financial year. But it's almost as if we like deprioritize that superannuation amount when it comes to our money. Like different dollars are worth different amounts in our mind, but it's just as important, and it's going to be really important down the track.
For sure. Okay, so let's stop beating around the bush with it. We know it's kind of important, or we're telling people it's important. Maybe we can start with the article you wrote and the reasons why it'd be important to start thinking about it as early as possible.
Yeah, so if you can start thinking about it as soon as you get your first job and start getting paid super, that's awesome. But even if you're in your 40s, 50s, 60s, just start having a look now and figuring out where is your superannuation. You can always go to the ATO website, chuck in your TFN and find any lost super you've got over your career.
TFN is code for tax file number.
Yes. So the ATO is quite handy now in telling you where you've lost money along the way. So and you can easily roll it over and things like that now into one fund. And there's a lot of sites now that we've shared before where you can actually compare different superannuation funds and looking at long-term performance, sort of 10-year plus, not the last year, when you're comparing different funds.
It's a lot easier today than it was even 5 years ago. Okay, so we know this is just getting on top, so sort it out.
Yeah.
Yep. What about the inside outside of super debate? And maybe you can just explain what we mean by inside and outside.
So people will often ask if you're investing for retirement inside of super and you're adding additional funds to that, it's usually you can't touch it till 60, 65, 70, depending on what age bracket you're in. I mean, the government will probably move the goalposts. Someone might be 75 by the time I get to retirement, who knows. But it's essentially the government wants you to save and have money put aside for your retirement, so that you don't have to rely fully or on the pension at all. So I guess that's their hope for savings. So and then there's also investing outside of super, which we've talked a lot about, but just building wealth up outside of super that you can sell or touch at any time. And if you need the money, you can just sell your investments, which you can't do with superannuation. You can't just pull out the money.
Yeah. I mean, there are extenuating circumstances with super, but make no mistake, it's not easy to get money out. And you definitely, as far as I know, it's almost impossible to get all of your money out of super early. So
it's pretty locked down.
Yeah, that's it. Yeah. So that's not even really an option. But so you're saying you can put money into this account known as our super fund, which we can't touch until maybe 65, maybe later, maybe sooner, depending on the circumstances. Or you can invest, like you can put money in your own bank account, your own name, in a brokerage account, in investment property, crypto, whatever you want to do. Yeah. You have more control over it effectively.
Yeah, you've got full control over it. And if you ever need the money, you can just sell those holdings instantly and get it, or I guess sell the house in a few months and get the money. But I mean, as a young person, the way I think about it is I'm doing both, because my employer's paying money into my superannuation and I'm also investing money outside of superannuation to build wealth independently of that. So I think it often depends on sort of when you start thinking about it. So maybe if you're approaching this at 50 and haven't really invested outside of superannuation before, your thought process towards whether I'm going to invest inside or outside of super would be quite different to what I'm thinking right now.
Totally. And so this is kind of one of these things that we call a false choice, right? You think that you have to make a decision, this one or that one. And we see this all the time. People are like, well, do I invest in this ETF or that ETF or that share, that ETF or property or shares? You don't have to pick one. You can have them all. In fact, I would encourage everyone to have all of them. So, think about it more so in terms of overall accumulation. How much of all of these things can you accumulate over your lifetime?
Yeah, because it's still your money inside super. It's just you can't touch it for a much longer period of time. So often people, if say they want to retire at 60 and they can't touch their super till 65 in this scenario, they might want to invest enough outside of superannuation to make sure they can bridge that gap before they can touch their super. So there are plenty of benefits to investing both inside and outside of super. A lot of people like it because it's for savings. If you're adding some money into your superannuation, then you can't just touch it for any impulse purchases, but you also can't touch it for other things you might like to buy outside of super.
If you wanted to do that too, you could. And you had a mortgage, for example, you could put money into an offset account, or into a redraw facility where you actually put it on the mortgage, and then you have to apply to get it back, kind of thing. So those are other ways that you can kind of keep it out of your little mitts. Or you can put it in another bank account with another bank, cut up the card so you can't access it easily.
And automatic payments options out of your bank accounts just to anywhere else.
That's it. Get it away from you.
Just as good. So I definitely, I wouldn't think it has to be one or the other. You can do both. Yep. And I think most young people that are listening to the podcast are having their employer pay their super, because most people are working full time, and then they're also investing outside of super as well, and maybe they're choosing to contribute a bit extra into their superannuation account.
Okay, how about when people say, retirement is so far away from me? I mean, this is probably a younger person thing than a middle-aged or an older thing, but so far away, retirement sounds boring. What would you say?
I think it approaches much sooner than you think. When I talk to older family members, they go, it suddenly just appeared. And suddenly I was living off my super or living on the pension. I didn't even sort of think about it. So life does start to go quickly. And if you put a few things in place when you're in your 20s and 30s, then you kind of can set and forget a little bit more. You don't need to actively think about retirement all the time because it might bring you down a little bit. But you can make sure that you have a really well-sustained retirement by doing a few things right when you're younger. And maybe that is adding a little bit to your super, or investing outside of it.
Someone said to me the other day, or well, it didn't say to me, I actually heard them say it. They said, no one's more motivated than a young woman who's just got engaged, right? And it's true. For money matters, and like paying off a credit card or wedding, children, you just found out you're pregnant. Whoa, now I need to start being responsible. Yeah. The other one is, oh my God, I'm going to retire in 5 years and I've got to actually rely on this money. All of these things, buying a house, all of these big things can be solved and painlessly if you just think ahead of time, just a little bit, just an hour or so here and now to think about these things that might be 50 years away. I guarantee that every minute you put in now, you'll get back 100-fold. Just not even in terms of money, just talking in time and just effort in understanding this stuff. Yeah,
and if you put some steps in when you're younger, then you don't actually have to you might not even need to put any extra money in your super to have a really comfortable retirement. Because we love the Money Smart compound interest calculator, but if you put in what your employer's currently putting into your super each month and maybe compare that to a scenario where you put $50 in extra a month, and you can sort of see how much your future could be changed just off a little bit extra put aside into your super each month. And it's quite interesting when you look at those scenarios and you go, well, I actually don't, if I start early, I don't have to change that much about my life to sort of make sure I'm going to have a great retirement.
Totally. Yep. Okay, so now we're going to maybe shift gears and talk about some more specific points that people might bring up with us. So you've explained really well the difference between inside and outside of super, but when is it too late to think about investing outside of super? So opening a brokerage account, buying an investment property, those types of things.
I think
when is it too late?
I'm not sure. There's some great tax benefits to investing inside of super.
Yeah.
So maybe if it's happening in the next, 5 to 10 years.
Yeah. And this is where a financial planner can help, right? Because they can actually sit down with you and be like, they bring out these fancy charts. If I was a financial planner, I wouldn't do these charts because I think it's overwhelming for most people. But they can sit down with you and they can go, this is where you are. And if you do this is what the chart looks like. And if you do this is what it looks like. And one of those things that they could do is, well, super for most people is taxed at 15%. But hey, you're earning and you're paying tax at 30%. So you'd be better off putting a little bit extra into super. So tax is definitely a consideration. And
often when you're quite close to that retirement age where you can access your super, a lot of people do shift gear and start putting all their money into the super rather than outside of it.
Yeah, they definitely take up that $25,000 limit at the moment, which is what it is. But they definitely take that up to get those concessional contributions rolling in. But as you said, my stance on this is don't think about it as one or the other. My in-laws recently, they've always been really supportive of me in doing what we do, but they've finally come around. They've said, okay, here's a little bit of money. What should I do with it? And they've started investing. They're like, oh my God, this thing's going up.
Yeah.
I'm like, yeah, isn't it great?
Yeah.
So, and they're thinking of retirement in 5 to 10 years, right? So, or even sooner. So, it's never too late to start. Absolutely never too late to start. Because, hey, if you know how to manage your money at 65, like if you've only just discovered investing at 63, you spend a couple of years working out what needs to happen, you've got the next probably 20 to 30 years on average in retirement mode where you've got to manage your money. So that's a long time to compound, even when you reach retirement. And another thing is, if that wasn't a big enough reason alone, if you just have all of your money when you hit retirement in cash, earning 1 or 2%, if that, then you take away inflation, your retirement's going to look pretty bleak.
Yeah.
But if you take an active approach and you think, this is how much risk I can take, I understand how shares and property and all these other things work, it's never too late to...
Yeah, it's almost like we think when we reach 65, then we suddenly go into the most conservative option possible. And if you're going to live to 100, where a lot of us probably will by, especially our generation, you don't want to suddenly be in cash because your money's just going to get eaten alive by inflation. So, you've got many more years to invest and compound your money.
Speaking of compounding,
you reach the retirement age.
The next one is, do I lose the effects of compounding by investing outside or inside of super? So what's the effect on compounding?
Yeah, so I think super's one, I kind of see them as, I don't know, it's sort of an overall picture for me. I just think of everything, a few different buckets, but it's snowballing into a big amount over the next few decades. And compounding's where you're adding money, but not all the money is added by you. Some is by income that comes from it. I mean, in superannuation, you don't really see the income and all that separate. It's just sort of one growing amount.
That lack of transparency that comes with super funds, hey? We can do a whole geeky episode on that.
I mean, I've tried to have a look. My super fund doesn't break down like what the income is, what the capital gains, all of that stuff.
But Kate, they're happy for that because then you don't know. And then they can take fees without actually calling them fees. Yeah. Anyway.
Most super funds don't really break down the nitty gritty. Yeah. But essentially everything from capital gains from making profits on things, whatever the super fund's investing in. Yep. Maybe they sell some student accommodation. Super funds do all sorts of strange things. And all the income and everything just sort of gets reinvested back into that super fund. So instead of giving you the income or the gains made from anything they do, it just gets reinvested back in and sort of keeps growing. So you, once you get to a certain point, more money is coming in from profits and income than is coming in from you, and it just starts to snowball over many decades.
Yeah, and we've talked about the big reason that people choose super over outside investments, and that's tax. But one of the things to remember is typically, you could speak to your accountant about this, but typically tax is only paid when you buy or sell or you receive income. So if you are, like me, a long-term investor who really doesn't do much but sit on his hands or her hands with investing and just accumulates and is not in the business of buying and selling every day, you'll find that you can get your tax liability pretty low outside of super as well. There's two ways you get tax for those who haven't watched our tax or listened to our tax episode. Capital gains when you make a profit, and income. One of the great things about Australian shares is franking credits. Who knows how long they'll be around. The second one is that if you are indeed a long-term investor, yes, you pay tax when you make a gain, but if you hold it for a certain period of time, you may pay less tax. Your tax bill might be cut in half. So if you're not chopping and changing, it's not necessarily like super's at 15%, outside of super's at whatever my marginal tax rate is. Then we have negative gearing and property. Then we have, no capital gains tax on the primary residence. All of these things that your accountant can help you with. So that's the major detraction from compounding. And money is money, whether it's inside or outside of super. Like I said, we said, let's have both. And just don't overthink it.
Yeah.
If you want to, you said it in the article really well, if you want to shave off, I think that's a really good way to frame it, shave off a few years from your retirement age, so not 65 but maybe 62, you have to do that outside of super. You have no option, unless you just want to eat lettuce leaves for like 4 years, like that you get from the Coles bin or something. I don't know.
Yeah.
But yeah, you get the idea.
So you definitely don't lose the effects of compounding by being in different places.
No.
Usually it's, by mucking around and changing and chopping and changing all the time.
Like your emotions get the better of it.
Yeah, I know some investors who every year they seem to take the money out of one fund and put it in another, and then they're not happy with that. And that's losing the effects of compounding because they're paying fees all over the place. They're locking in capital gains and losses left, right, and centre. So usually you pick a strategy that works for you and you stick with it.
Yep, good, well said. And if you don't need to buy or sell, just get another one if you want another one. Okay, so the next kind of point is, what do you do if a super fund raises its fees?
And I think that's off the back of quite a large...
Did you say Australian super? Oh, sorry.
No, I don't know.
Australian
Recently?
super? Oh, my... How much do they have invested?
I was just going to say...
120 billion?
And Arbitrary Super Fund raised their fees recently.
Who did? Who was that? Australian Super? Oh, my gosh. Okay,
and I think they raised their fees last year or the year before as well.
Yeah, probably.
Yeah.
It wouldn't surprise me.
So
anyway, we could be wrong.
Yeah.
But we know that they raised their fees. And they're the biggest super fund in the country. What the heck?
So your super fund writes to you, because I think they have to tell you in writing that they're doing this, because they get to update their product disclosure statement. They tell you that they're raising their fees by, 20%.
Yeah, or even $20 a year.
Yeah.
Yeah.
So what should you do? Should you just ignore it? Should you do some research and find out if it's still comparable to other funds? Should you just switch without thinking? What do you reckon?
Well, I think it's all down to whether or not it's still, like, I don't think super funds can do this anymore, but there used to be a thing called exit fees. But if we just think about the cost of finding a new super fund in terms of, this is why giving advice, and we don't give advice on super, but if someone gave advice on super, the one thing that's really risky for them to tell you to do is to change super funds, because you might have to pay fees when you change. But the big thing is insurance. You might have to get a new set of insurance policies, which might not have the same levels of cover or might have exclusions, those types of things. So it's always one of those areas where I'm like, do your homework before you go and switch.
Yeah.
But again, there's nothing to say that you can't. Let's say you've got $50,000 or $100,000 in one super fund. We know we don't want to have multiple super funds, but you could. So you could start directing it somewhere else if you're concerned about that one continually raising its fees, or you could just switch. You could, but just know the risks of switching and know the costs. What would you do?
I think I'd definitely do some research. I'd first go, well, I mean, if it was already one of the lower cost options, then maybe they're just raising their fees in line with industry average. Yep. And once you do some research, find out if you're in a balance fund, then compare apples with apples, because some super funds have more high growth options that are more aggressive and charge more fees. Mm-hmm. So check out, I think is it Chant West or one of the...
They do it, yeah.
Yeah, it's a free comparison. It's got the Apple.
Yeah. And then I think there's super ratings.
Yeah, so have a look at what you're paying now with the new fee structure for your fund versus 10 other comparable funds. So like if you're an industry fund, compare it with other industry funds. Like retail's often more expensive. So so compare similar products together and see, well, is it actually now kind of standard, or is it still a bit cheaper, or is this increase tipping me over? And then maybe, is it worth it to switch? Like, what are the costs? Are there exit costs? And then insurance. If you've set up your insurance properly with an advisor or something like that to suit you and your family's needs, you're gonna have to do a bit of homework to find out if any new options will be able to provide the same resources. And I think that's what super funds rely on, that inertia, that to do all the research and then to get the new insurance set up and everything like that. It's sort of almost too much effort to switch. So you're not going to do much for a $20 a year fee increase or whatever they choose to raise it by. But I definitely have a look and make sure that it's not going above industry standard level of fees. And then if you do think it's sort of too much in terms of fees compared to what you could be paying with other super funds, then maybe do your research on the different investment options, because balanced is not always the same as balanced somewhere else. Everyone's got kind of their own view. And then make sure you've got the insurance and various options available to you. And if you do change over, don't forget to tell your new employer. Tell your employer new details. Otherwise, you'll end up with super all over the place.
One thing is with super funds is that, and but including industry super funds, which is the type of super fund that is run, as they say, quote, only to profit members, end quote, is that there is a lot of stuff that goes on underneath the surface that people like us in the industry know could be happening, that doesn't necessarily reflect what you expect is happening from the outside. So, we could go down, I guess, a rabbit warren on this one and pop out anywhere. But the thing to be mindful of is that make sure when you're comparing super funds, even from these so-called comparison websites, make sure you're comparing what you'll actually be getting. So the strategy as well. Like you said, growth. So some super comparisons are only done based on the My Super strategy or like the balanced strategy. But maybe you're not a balanced investor. So one super fund might look cheaper. But then you're like, I want a growth strategy, but it's like 4 times the price. You should be comparing that growth strategy plus all the other fees and insurance with another one of like identical or similar nature. So keep that in mind. Anyway, but yes. So long story short, you can definitely change if they raise their fees, but just make sure it's cost effective and
you do your research and like how much better off. If you're only going to save maybe a couple of dollars a year, and you're pretty happy where you are, well, is it worth it or not?
Yep. So another one is, how do you actually work out what your super is invested in? This is a big thing with ethical stuff.
Yeah, and I think more and more people are interested in the moment about where a big chunk of their money is actually going and what are they resourcing. Is their super buying and building apartment buildings, or is it investing in farms or solar panel industries, like where is that money going? Or is it just going straight into ETFs? And there's no sort of picking and choosing at all by the super fund provider.
Yeah, so soon that I laid the boot into Australian Super, one thing you can do with a website like theirs is if you go into your member account, you can see the types of investments that they're making. So they might have, we own this much of a Melbourne airport, or we have this many Westpac bank shares. You can see, it may not be exactly for you and how much you own through the super fund, but it might be for the entire super fund in that strategy. So you can work that out. And then you can go from there. If you're one of those people who I only want to invest in ethical stuff, well, they might have an ethical option, which then you can drill down into and have a look on their website.
Everyone's ethics are going to be different. So you might have to look at a few different options to find out what might align with your views. And often the product disclosure statement will say some things, maybe what they avoid. But they usually don't give you a full 100% breakdown on everything they're invested in, which is, I guess, to the advantage of the super company. They can invest in, there's super companies investing in things like private equity, and you have no idea what that could be, and other managed funds and all sorts of things. So there's usually quite a mush pot of different stuff going on in that super fund that you probably can't find out, but you can at least ask them, even call them up and say, what are your list of things you actively exclude from the fund?
And there are always other options, right? You can look at other super funds. Some of the biggest super funds nowadays do this kind of like half self-managed super, half we do it for you kind of thing, which is, it's effectively a brokerage account inside your super fund. So it allows you to pick the things that you want to buy. So if you wanted to know exactly what you owned in your super fund, you might be able to look into something like that or speak to an advisor and
there's definitely a few companies that you do that. It's a bit higher fees because more control, but you're sort of buying the different shares and ETFs off a selected list under them. So it's not entirely a self-managed super fund because the assets are still held under whichever company, but you get a bit more control about where your money is.
For sure. Okay, and the last one here is, will super funds start to have more power over the market as their FUM increases? And FUM, did you want to explain it?
Yeah, so funds under management. So that's the total pool of everybody's money together. So for some of our big Australian super funds, that's billions and billions of dollars.
Yep.
And probably hundreds of billions now, I don't know.
One of them I know is over 100.
Yeah.
Yep. So will they have more power?
I think we're already seeing that. I'm seeing that some of the big super funds are actually coming to the table and they're actually starting to talk to some of the large companies they have stakes in and sort of telling them what they expect out of them. So it's quite interesting. And it's definitely worth, when you're doing your research about what your super's invested in, also find out about what their position is when it comes to voting at company AGMs, and do they actually come to the table and talk to the companies they're invested in? Because some of these big super funds end up having a 5% stake in Australian companies, and they've actually starting to have negotiation power.
Yeah, and this is the thing is, because we're mandated to have money in super, like our employers are told you have to put this money in and you're going to have to do it for the rest of this person's working life. In 20 or 30 or 50 years from today, they're going to be even more powerful. They will be more powerful than the banks are right now. They'll be more powerful than the mining companies are. They'll be more powerful than all of them. And some might say we're already at a point where they're maybe as powerful as them, because they have 2 million members to represent. So some of the things that you can do to check on this is read their websites. What do they believe? So, everyone is entitled to their own opinion. Maybe your super fund believes that active investing, as in, picking individual stocks, is the best way to do things. Maybe your super fund subscribes to the idea that we'll just invest in ETFs, or we'll create our own ETFs and index funds and do it that way because we think that's more effective. Maybe we should check to see who's on the board of the super funds. And maybe we should look at their character and who they're associated with. What, maybe not political parties, but quasi-political parties. Or
you can learn a lot about looking at the chairperson of these super funds that runs the board, looking at their past board history, their past employment history, anything associated with their name. You get an idea of maybe how they're starting to lean, because the board's got a lot of control over billions of dollars of assets. And
totally.
It's going to be very interesting to see what they do with that power.
Yeah, maybe if the board of directors are appointed from somewhere in a particular industry, if it's an industry super fund, that industry is represented through the super fund. That's an important consideration. And then where do those directors' fees go? Are they going to the individual for representing the members, or are they going to some sort of party, I will say, who represents a certain group within an industry?
Yeah, it's quite interesting because some of the industry super funds, there's sort of a healthcare super fund where a lot of employees in the healthcare industry have their super, and a lot of employers in that healthcare industry point members to. And are they taking a more activist approach when it comes to issues affecting their workers in what they invest in? So it's definitely worth asking those sort of questions about how is the company voting, and how are members' voices heard, and how is the sort of position this super fund has in the community utilised. And
transparency, what are you doing to make it more transparent? Can I see what I'm invested in? Have you made the tools easy for me to understand? Are you disclosing all of the fees, or are you kind of hiding them as net investment returns?
Or is it saying it's an active investment strategy, but really it's just an ETF? And a few people have gotten in trouble for advertising a special strategy when really it's just an exchange traded fund. And you shouldn't be paying extra for something that's not actually happening. Yeah,
so there's all these questions, and little old you has to kind of sit back and just be overwhelmed by all of this. But the one thing you can do is just, you can just read the websites, understand what you're invested in. Don't necessarily get sold on things by other people. So don't let individuals convince you that some super fund's good for whatever reason, or they don't do this, they don't do that. All of them are good, all of them are bad. It's just about trying to find the one that fits right with you and what you believe in. So anyway, that's my rant on super.
So a few things to think about on the superannuation and retirement page. And definitely put, as I've mentioned before, a calendar invite in your diary on a reoccurring yearly basis at least, to check in with your super fund, find out if they've increased their fees, because you might not have noticed during the year. Check what they're invested in, how they approach, are they an activist super fund? And just sort of look, is it actually performing as it's supposed to for the strategy you're invested in? Yep,
all good things. And Kate's got this article on How to Money Australia, the website, so we'll link to that. We've created a super course, 10-part super course. If anyone wants to take it, it's free. You can Google the names of your super funds and see if, click on the news tab, see if they've...
any recent AFR, Sydney Morning Herald articles are popping up. I think one young man was trying to sue his super fund recently, which is it'll be interesting to see how that case goes.
Wonder who can pay the lawyers more. So, interesting, all good stuff. And so, Kate, if people want to hear from you...
you can catch me at howtomoney.online, or Twitter and Instagram at howtomoneyAUS.
Yep, cool. You've got another podcast, How To Money, as well, which is a great one. And you can find me... We've got a new website, www.rask.com.au. Same emails still work, and still on Twitter, still on Instagram, though I don't check Instagram as much.
Still trying.
Still trying to work it out. I'm also on TikTok now. Are you on TikTok?
Oh, no, I'm not.
I gave it a shot. It's crazy. I just get sucked into this vortex.
One of my colleagues is showing me the videos. I don't think I want to be on there.
It's pretty trashy, but it will become good, I'm sure. Okay, cool. Kate, thanks for joining me.
All right, thanks, Owen.